Okay, so we're live. Hi guys, if you can hear me, um, if you can hear me, you can introduce yourself in the comment section, your name, your location, and your startup name, so that we know the founders here. Okay, we can see a couple of people joining. So if you can hear me clearly, your name, um, your startup name, and your location. So today we are expecting a lot of founders from some from the builders community, some from the AVS community who are still building their product. So today our topic is centered around building real real product market fit in Africa's fragmented market. And today we have with us, this is 11:04, so we are going to start. So today we have with us Osaro Jackson, the COO at Bridge Labs. Hi Osaro, good to have you here.
Hi, Pascal. Thanks for having me. Excited to be here. Thank you.
Okay, so Osaro, Osaro is the CEO at Bridge Labs. And before we move into Osaro's bio, we also have Mercy. Mercy is the stablecoin and blockchain vertical lead at Flutterwave. Hi, Mercy. Good to have you here.
Hi, Pascal. Hi, everyone. I'm Mercy. It's nice to be here to discuss with you.
Okay. Thank you very much, Mercy, for joining this session. So, Osaro is a seasoned marketing and operations lead with a strong track record of building, scaling, and operationalizing businesses across African markets. With experience spanning fintech, mobility, and Web3, he brings a rare blend of strategic thinking and executional depth, combining market expansion, operational design, and growth strategy to turn complex, fragmented environments into scalable systems. Today, Osaro focuses on helping companies move beyond surface level growth to build durable operations that actually work in Africa, making him a trusted operator on navigating scale, localization, and execution in emerging markets. Osaro, welcome once again.
Thank you so much, Pascal. Appreciate. Thank you.
Hey, so Mercy is a fintech and blockchain operator with 8+ years of hands-on experience building and scaling payment, stablecoin, and cross-border infrastructure across Africa and global markets. She currently serves as stablecoin and blockchain commercial vertical lead at Flutterwave, where she drives go-to-market strategy, ecosystem partnerships, and the compliant adoption of blockchain-based payment and settlement solutions across fragmented and highly regulated markets. Macy's work sits as at the intersection of payments, regulation, and market reality. Her expertise spans growth strategy, market entry, African market penetration, business development, regulatory navigation, and data-driven execution, making her a trusted voice on how emerging technologies like stablecoins can unlock real economic value in Africa. Good to have you here once again, Mercy.
Great to be here. Great to be here. Sometimes when you hear your bio being read, it's very jarring.
I tell you.
Okay, so just a freestyle question to both of you. What are your expectations for this session today? Let's start from Mercy. What do
My
you expect startups
my
to go away with?
My expectation from this conversation today is that we learn something, right? We go back with a little bit more knowledge than we came. I learned something from conversing with Saro. Every time I speak with him, I learn something new. So I'm looking forward to learning something new here, and and sharing a bit of things that I have with others people. Hoping that if there are questions, I'm able to put some light on them or provide some clarity to those questions. Yeah, those are my expectations.
Okay, thank you, Mercy. So over to you, Osaru.
As Messi said, we're looking to see how we shed lights. Share some of our experiences and share some of the logic to the end that the startups and everybody on this call lives here better than they came, having a bit of direction on what to do or what not to do anymore, and all that. To the end that businesses thrive because of this engagement here. Yeah, and I'm happy. I want to listen to Messi also. It's been a while.
Okay, okay. Thank you very much to you both. So the startups here, just as a quick introduction, this conversation is around product market fit in Africa. So you would agree with me that some of the copy and paste ideas in terms of execution and all that we learn from maybe the US or Europe, some of them do not fit into the African market. So we will need to realign or readjust some of those ideas to be able to fit into our own market. And Africa is not just a market. There are so many markets in Africa, just like you have the different cultures. The way you sell to, let's say, a Yoruba man is different from the way you will sell, let's say, a physical product to an Hausa man. So even in Africa, even in Nigeria, there are different markets. So it depends on what you are selling and what the culture and the environment around that product is shaped. So that will determine how you build your product market fit or your go-to-market strategy and all of those things. So we start with the first question. So let's start with Osaru. So Osaru, what does product market fit mean to you?
Simple. It's simple. It's a product that meets the needs, building a product that meets the needs of users, right? Product market fit is basically building a product that is needed. If I need cold water, you give me cold water, you get me cold water, we have it product market fit. And I'm willing to pay for it. So it's not just meeting a need, it's a need that people are then willing to pay for, right? So that's the first of, I've met the need, I can meet the need, but it's a need that people are willing to pay for. It's a need that people are willing to pay for consistently. Right, to the end that it's not a one-off thing that okay, if they've had one of it in their lifetime, they are fine. Will you have repeated purchases and all of that? So are people willing to pass away money for that product? So summarily, what I've said is this: it's a product where products meet the needs of users, willing users who are that are willing to pay money for the product. Yeah.
Okay, thank you very much, Osaru. Mercy, do you have any addition to what Osaru has said in terms of product market fit?
Yeah, he pretty much covered it. So, product market fit pretty much is you have round square bit products in a round hole, right? A round object in a round hole. What the customers say that they want and what they're willing to pay for, you have created that and you can fit that into that market. And that is pretty much what it is. It is not building before your time or after your time, but right there, what the market actually wants. Yeah.
Okay, thank you very much, Mercy. So Mercy and Osaru has mentioned a couple of things. Number one is need. You have to be filling in a need for the customer. So there has to be a need. Of course, there is a difference between a need and a want. So there has to be a need for a product, and your own product is actually filling up that need more than every other product in the market. And the customers have to also have the ability and willingness. So it's one thing to have the ability to pay, but you don't have the willingness to buy the product. Or sometimes you might have the willingness to buy the product,
Not
but
have the
you don't
ability.
have the ability or money to purchase. So all of these things are like diverse phases to having a market. A market is not just a group of people. Sometimes you ask founders, who are you selling to, who are your market, they will say everybody. Your
Yeah.
market has to have the ability and also the willingness. So someone might have a huge amount of money in the bank, but they are not willing to buy your product. Is it that there's another product that does the same thing better than your product, or they don't just want to buy your product? And some of
Mm.
them might also have the ability, but they don't have the need for your product. So all of those things are kind of uniqueness when it comes to building a product market fit. So I'm seeing a couple of founders here. So founders, this is very important. A market is not just a group of people or a traffic. Founders, we are still waiting for you guys. If you are here, just your name, your startup name, and your location. That's all. We are not going to ask for your address or where you are living. Just your name, your startup name, so that we can see those here. So when it comes to product market fit, a need, and your product is feeding that need more than everybody else. So this is very important. You might have there might be a need, but your product might be the substandard one. So for that need to be actually a need you are filling up, your product has to top the list of other vendors in the market. There has to be a willingness, and there has to be the ability of the market to actually pay for that product. Okay, so we move to the second question for Osaro. So let's start with Osaro. Osaro, what's the standard lean startup methodology?
Okay.
Or let me rephrase again. What is lean startup methodology? Let's start from there.
Oh yes. I mean, so the lean startup methodology says you basically start with building an MVP, a product. So, and then you move to the point where you are then getting feedback on that MVP, which then you then need to decide whether you want to pivot or persevere on that product. I mean, basically, it's a case where we're saying we have an idea, let's go to market with it straight up. What we're building, so the idea is this, is big like this, but let's build something small first, which is our MVP, and let's launch that in the market. Let's get feedback from the markets. And this is against the traditional style, which is a case where I'm taking a longer time to even go to market. I'm first doing some level of planning. First, the traditional style says draw up a business plan, showing a 1-2 year business plan, showing the development of the product itself, the marketing strategy, how we'll get funding, put all of that in a document, and it takes a bit of time for you to evolve. So that may take you between 1 year, that's the traditional method. But the lean method says, let's not wait for too long. Let's just build something small, go to the market and test. If it works out, fine. If it doesn't work out, we'll trash it and start again. However, you would see that in Africa, you can't really operate. So you have to find the right balance between utilizing the lean method, right, and the traditional method. I mean, I would say honestly, right, the lean method, for example, in Africa, it's not easy. It's not easy to just jump into. It's not easy to leverage the lean method, which is where you build, measure, and you basically iterate, as it were. We have a couple of problems. Infrastructural issues, right? In Africa, you have to deal with providing your power sometimes, providing your water, providing, roads, security, and all of that. To the end that in building your MVP, if these other infrastructure are not available, you may not scale properly in itself. Sometimes it looks like you need to provide that yourself, which can then make your MVP building very expensive. And users are not willing to then pay for it because it's too expensive for them. right? Because I mean, the average business in Nigeria today, you are looking as soon as you are. I mean, if you want to even say, okay, let's even work from home. The home you're working for, you have to provide power yourself. Get an inverter, or you're running diesel, right? Or you are dealing with security issues and you're around there. To the end that it then makes your MVP. It can't be that fast as it is in the West because you have to develop some of those things yourself. You have to provide your power yourself. You have to provide some of these amenities that are basic yourself. It makes that so it affects how fast you can even operate that lean model itself. I mean, we're also dealing with a lot of economic issues, macroeconomically, right? Where we're seeing our rate of inflation go up faster than you can even pivot your business itself. We're seeing the currency devalue in several parts of Africa faster than you can even build your MVP and even go to the market with it. And so it's like when you at this level, the inflation rate was at this level. Before you finish building, it has gone up here. So you have to then re-strategize again so that you're even at par with what's happening macroeconomically. And I mean, also regulatory orders here and there where sometimes they are unclear. And so the guy who wants to operate the lean model in Africa has to think twice. And so my counsel with this will be this. While I understand the lean model works in other parts of the world, you have to localize that approach and contextualize it. What does that mean? You want to, because you even go ahead to build your MVP and go to markets. If it doesn't work, you don't have so much of capital in your chest to fall back on. If it's gone, sometime it's gone. You have to go and carry your CV and go to Messi and say, Messi, I need a job right now. That kind of a thing. Because it was expensive. It will be a big risk you took. Use almost all your capital to do that because you also have to provide many things for yourself. So what I would advise in localizing that lean model in Africa is maybe don't run as fast as the guys in the West will do in creating that MVP. You want to do some level of research. Right? Understand that terrain. Like you were saying earlier, everybody's not your customer. Do those basic research that tells you who are the customers you want to target, what do they really, really need? Not just what they need, what can they pay for? What is the minimum viable product that will appeal to them? Let some level of data guide your MVP launch. Whereas the lead model says, let your MVP, the data you get from your MVP guide what you finally do. I'm saying for Africa, let data guide your MVP building. You get what I'm saying? The lean model says, do your MVP, gather data afterwards. After a few users use your MVP, gather data and then decide for the future. I am saying in Africa, gather a bit of data in the market from competitors and all whatnot. Gather that data to then build your MVP, right? And then further look at data afterwards, after you have built your MVP, and then you can scale from that point. That way, you will find out that some things you want to even build because of the fact so that you don't burn your limited resources as an African. Some things you don't, and some things are not even worth building. I'll give you an example. I and my friend were trying to say, hey, there's a lacuna in Africa where it looks like you can easily move goods, physical goods logistics. It looks like you can physically move goods easier between Nigeria and UK than even Nigeria and Kenya. Though we're in Africa together, and we're like, oh, we're going to solve the problem. We're going to solve the problem, bro. When we got into doing the actual research, we're like, no. In fact, the first signal is the fact that there's hardly anybody in that space doing that Pan-Africa logistics business, which is a signal that you're not the most intelligent person, bro. If nobody has cracked, it's because maybe there's nothing to be cracked there. It's a big problem that you at your level cannot solve. Maybe the bigger guys who are established should go solve it. So that data we gathered, looking that there's not too much computers there, means that there's not much happening there. It looked like a good market, but the operational issues there showed us that this is not something we can deal with at this level, and so we have to backtrack and take a back step and went into doing something else entirely. MVP, lean startup would have said we should just go in, just launch something, all of that, and then you then find out that it's not something that can work. We would have burnt our capital and burnt our time there. How does that make sense?
Yes. Perfect. Okay. Messi, I don't know whether you have anything to add to what he has said.
He kind of talked about everything. He's right. You have to go into this with your eyes wide open and read data, right? Whilst, like he said, there are some structural issues that we kind of face in Africa that might not be the same for other clients. And this have informed all the theory and the theorizing and the research and the academic that we have, right? And you have to think about these things in context, in your context, in how does this work? How will this work if I translated this to Africa? You have to go to it, think about the data, think about what is happening, what are my corridors, what exists, how much am I going to spend here. If again, if you have all the money in the world, by all means, you can go with that and try something up and throw it at the wall and hope something sticks. And that will be great, right? But if you do not have all the money in the world, then I would strongly advise that, like Asaro said, you go in with your eyes open, you go in with some data, even while trying to build your PMF, your MVP. Sorry, you're trying to build your MVP. You go in with data. You do that data to build that MVP, and not just with the MVP will give you some data, right? It will. It will definitely give you some data. You will get some information from it, and you should do that. You should not build. I don't think you should build your entire product at once and come to the market. Hey, I'm out here. I think you should come in small, but even as you're doing that, you should do that with thinking, with thought, and with planning. Yeah.
Okay. So thank you very much, Messi, for the additional thoughts on lean startup building. So while Osaro was speaking, he mentioned something about fluctuation and all. So I remember that you also work within stablecoin verticals and all. So how do you think stablecoin verticals can help? How do you think the stablecoin and your own side can help with this fluctuation in currency when startups are building?
Okay. So in Africa, right, currency volatility is not a macro problem in the background. It is a product environment. It is real, it is live, you can feel it, it's palpable. If you're building in Nigeria and Ghana and Kenya and Egypt, across Francophone Africa, FX instability directly changes how your customers behave week on week, right?
Yep.
And so if your product ignores currency reality, you are going to die. There's no other way to tell you this. You're going to suddenly stop working. So the first thing you have to do is stop treating price as a number, but treat it as a risk contract, right? You have to be aware of it. You have to accept it. You have to be sure that this is the market I am building in, and there's nothing I can do about it. And so when you first go to come with that analogy, you have to think of building like a fintech product, like building a house of moving sand in Africa, like you're building a house of moving sand. You can have all the best design in the world, but if the ground keeps shifting, the house will crack unless the house is built with movement in mind, right? And so you have to think about it from that POV. Now, if your customers, you have to think that your customers are not just buying a product, they are buying protection. So when somebody uses stable coins or USD pricing or uses cross-border payments as opposed to using the bank, the person is really saying, I don't want surprises. That's what the person is saying. When you use stables, you want predictable value, predictable fees, predictable settlement time. And that's what stablecoins bring into this market, right? They bring some sort of predictability in a moving sand kind of feel, right? You need to stop thinking about price as like I said, like a number. I think about it as a promise. You have to think about it. In water market, pricing is emotional, which is trust based. I mean, if today you tell me this bottle costs 5,000 naira, and I come back tomorrow or 1 month after, now it costs 7,000 naira, not because the product quality changed, but because FX moved.
Yeah.
I will first feel cheated, right? But it's not your fault. But it's not your thinking. But if you choose a stable reference, if you choose stable coin pricing as at the background to benchmark your planning, right? You are able to hedge for those shifts here and there because you have already put that in the thought process, in the thinking from the very beginning. You've already hedged your pricing against something, anchored it against something. For customers, you're anchoring against price instability, for FX volatility and inflation. For merchants, you're hedging against they are merging, the merging collapse, merging against merging collapse. So platforms, you're hedging against your treasury risk, right? And so you want to make sure that you are building with that thinking and you're building with that in mind, you're going to have to start looking for PMF signals. In unstable markets, users don't want to just move money; they want to hold value safely. And so, if you are doing it right, if you are pricing rightly, if you are pricing smartly in a volatile market, is pricing with stables, you will see you will see PMF signals like users keeping their balances longer, users funding repeatedly because there's predictability in pricing, there's predictability in fees, there's predictability in the settlement value and what they're going to get. And that is what the blockchain, stable coins bring into this entire system. In Africa, price or currency volatility forces you to build products that behave like stability, and that's how your product wins the unpredictability wars, right? You have to build your product to behave like stability, and the way that you can do that is like layering it under with stables, thinking around it with stables or with USD pricing. And we know the market today, you cannot really just access USD or FX like that, and that's where stable coins come in, right? They give you another thing that you can access that's easy to get to, easy to access, it to plan with, that is giving you the exact same stability as you would with a fiat currency, a stable fiat currency. And so, yeah, those are my thinkings.
Okay. So, Messi has mentioned a lot of things, but before we push this question to Osaro, I want to ask Messi. So let's say a startup in okay, let's still use fintech. Let's say fintech startup wants to build around stable coin. What's the reality around it? How can they actually build it? So what you've said now is like you've said a lot, and it's like, let's say, big grammar for some startups that are still building. So let's say they want to actually build, they want to get their hands wet.
Hmm.
What's the actual way or step by step way they can actually do that, building around stable coins?
Okay, great stuff. Now you want to collect all my tickets I'm paid for, but I'll share some thoughts, right? So building stable coins are, think about them like you would think about. The first thing you want to first do is not think about stablecoins as some niche or deep products. Think about them like you would think about USD or FX, because that's what they are essentially, right? Essentially, they are digital representation of a fiat currency. So the first thing you want to do is think about it like, okay, if I was building a product that, and I wanted to hedge against cost or pricing or whatever, or I was building a product that was going to do whatever thing that your product wants to do, how do I want to do that with USD in the mix or with FX in the mix, right? So you're thinking about building features that allow you to, stablecoin balances that allow you to use them as a store of value, right? That might be something that you might want to think through. You might be thinking about fast cross-border settlement rails with stablecoins. You might be thinking about multi-currency rails where it makes sense, right, with stables. These are things that you can build. These are things that you can build around. As stablecoins can help you to think through and build around. Stablecoins largely help to, they are a payment tool, right? So they just kind of help you to store value, to make payments faster, to open more settlement rails, to be more predictable and be more transparent in the fees. And so, knowing that that is what their functions are, you can then use that knowledge and infuse that into your fintech product. If I wanted to create a savings product today and I wanted the savings product to be such that it will provide my users with yield or meaningful yield, or I want to guarantee them budget, I mean, it might make more sense if I do that in stables as opposed to doing that in naira. Because if, for example, because of currency volatility, if somebody was saving for this bottle and this bottle was seven naira today, by the time you wake up tomorrow, it can be 10 naira. So even though I've created that lock savings and I have given you $2 on that, I mean 2 naira on that, your 7 naira that you had saved, or 1 naira, that's 7 naira, you have not made enough to buy the product that you actually were saving for. Right. But if I had put that in stable, if I had put that feature in stable, you most likely would have already saved that amount and even a little more, because again, the volatility in currency might have helped be in support for you, and then when I put my extra yield on top of that, it kind of adds up for that customer. It makes sense. And so you can think about it like that, right? Think around, these are the features that stablecoins can do for me. These are the functions of it. It can help me open more rails for customers to pay around the world. And so that's something I want to utilize it for. It can help me make settlements faster, no T+1, T+2, and all the others. And that's what I want to utilize it for. So you have to think around the features, the utility of stablecoins, and what you are building, and then infuse that in there. There's no one clear-cut path to how to use stablecoins. It's just, what am I building? How can this tool help stabilize what I am building, and then infuse?
Thank you very much, Mercy. Just one extra question. So, can you give an example of um, a startup or a tech product in Africa or in Nigeria that is actually built around stable coin versus another one that is also built around unstable coins?
Who be this guy? Wow, very interesting. Okay, so the question is, talk about a startup that is built around stables
Mm-hmm.
and a startup that is not built around stables, right? Okay. So today I am strategy lead, I mean stablecoin lead at Flutterwave, and we are building around stables today. We are putting stables in our layer, in our payment infrastructure, to supercharge that. Before that, we weren't doing that, and so this one feature this one company kind of answers both. Before that, we were doing every other thing but stables, right? We were allowing you to pay the way that you pay, and we had done that really, really well. Photograph had done that really well, conquered Africa and more, right? And that is great. However, if we are going to supercharge that business and be truly the payment infrastructure for Africa, we have to look at how is Africa paying today. African payments have moved a lot from cards, if you think about it. People are using alternative methods to payment. I would, in Nigeria today specifically, you will most likely find somebody who want to do a transfer from OPay, PanPay, MoneyPoint, or then you will find somebody who wants to bring out their card to pay. It's almost faster. You got transfer, oh yeah, make I do OP. Do you get? Than cards. Um, time when cards were the thing, but people have moved on a little bit from that, and we are seeing more people have moved on to from banks sorting your FX payments or all the other platforms that are sorting your FX payments to stable coins, because we have seen errors where airlines got their money stuck in the bank, they couldn't repatriate it out and things like that. People have gotten burnt with other traditional rails, and so with Flutterwave, it got to a point where you have to think about it and say, hey, this is how Africa is paying today. This is how this is the changes that are happening, and we have to make sure that we are building for that, because that is the future, that is now, and that is where we are going. And that is where we are now. Now we are building with that in mind. We are providing stablecoin balances to consumers and merchants alike, because we have realized that it will make it faster, it will make it better, it will supercharge the rail entirely. It opens up more corridors for us, and it collapses time. It then helps our merchants be able to think clearly in terms of their planning, when they can make a payment, how they can make a payment, and not just big merchants. From a perfume maker that is, you are ordering your supplies from Turkey, you can now complete that transaction on the same chat. Oh, I want to confirm, I want to order five kg of this. It is 5 riyals. All right, send me your wallet address. Send to wallet address. Transaction sent. Your payment is now moving like a good song, like a good rhyme. It's just in the same bit of conversation. It's no longer the one of send me an invoice, send the invoice. Okay, you will get paid in 5 days, and then in 3 days the bank is stuck somewhere, and you start talking, and no. And that is where we are, and that's what we are thinking. That is what we have moved into, right? And so building around stablecoins is changing the way that business works. For where Pottery business is going to be, how it works, and how the thinking that we have with us, and how it's going to be in the future, and as opposed to what it was, what it is today, or what it has been, right? So whilst we have done a good job. There is something that stablecoins bring. It supercharges that good job. So for every other startup, right, you may have done a great job, but payments have changed. People have moved in terms of how they are paying and what they are paying for and how that is working, and there's a whole modalities around that. And I would suggest that you should, take a look at that and move with them. Except your model is possibly to, even if your model is to dig deeper, even if your model is to only focus on one market, not interface with FX and all the others, even if it's to dig deeper, you have stables like CNGN, for example, that are digging deeper into the Nigerian currency, right? But they're making it better and faster for you to pay. If you don't have a bank account, or if you're not able to, you don't want to hold your funds within the bank, you can do that with CNGN. You can hold it in your CNGN wallet. You can do the same payments that you would do. So there are stables is not just for FX. Stables can be for both FX and for intra country trade, right? And so you need to think around things like that. And that is how I'm just giving like an example of how Flutterwave has moved. We are is expanding and is being better with adding stable coins on the layer as opposed to what we were doing before, which was really good. We conquered Africa with that. And so we're just doing a little bit more because that's where Africa is going to.
Yeah, thank you very much, Mercy. Should I ask more question based on this? Okay, so let's move it to Osaro. So Osaro, do you have anything to add based on what she has said?
Oh man, I mean, I think that she said quite a lot. I mean, that's what she gave is the masterclass there. So, I mean, not everybody will touch stable coins. That not everybody's business need to touch stable coins, right? But if you are around payments right now, and so first, there are many uses. As a business, you can choose to save your funds. You can choose to save your funds in stable coins, which ensures that you are edging against inflation and currency volatility, right? Individuals do that. A business can also do that, so that to the end that you're not keeping your money in local currency, that is, and then it's exposed to those macroeconomic factors, and that can be one reason why you touch stable coins. To the end that your the amount you have in the bank it's moving in tandem with what is happening within the economy itself. So that's one reason why you can touch it. Now, if you're a business that requires that, I mean, maybe you are you import goods from abroad, you import goods from Turkey, from China, and all that. You at the point in that value chain, you got to touch stable coins. Or you are a startup whose business involves importation of goods from outside the country. Some way, somehow, you got to touch stable coins at this point in time to speed up your transaction processing. Now, the traditional banks will take you between 7 to 10 days for you to move your funds across the world to make payments to your vendor wherever they are. 7 to 10 days before that funds get delivered and then before they start shipping. Whereas with crypto rails, stable coins, that can happen within minutes, hours, right? The worst case, 1 day, 2 days, you are fine. But I mean, it's getting to the point where it's even now within hours, where first, in a sense, if I don't need so much liquidity, don't ask me what liquidity is because I know we can extend the discussion. Now, if I don't have enough, if I don't need so much money where I have, maybe say it's 100K, $100K I need, I can actually, that's easily accessible in that sense. I have it in my account. My vendor, my supplier is in China, and it needs to get paid 100K. I can just get that stable coins in my personal wallet and send to the person, and in 1 minute, 2 minutes, that money is paid. So what typically would have taken me 7 to 10 days with stable coins, I'm done with that transaction in 1 to 3 minutes. And so you can start shipping. So these are the ways you can even streamline how fast you ship to markets. Because it's because of stable coins right now. So you see how it's giving you speed, and how it's ensuring that you're also able to keep your wealth on lockdown, so that it doesn't move haphazardly because of currency volatility. So there are many use cases, and based on what you are doing, there will probably be a need, and not everybody probably. I mean, but at an individual level, you probably will touch stable coins in your life. If you travel, you got to touch stable coins in a sense, right, and all that. Oscar, you have more questions along this line?
So we've really delved deep into stable coins. Yeah, we've delved deep. Also, startups here, founders here, if you have questions, you can send in your question in the comment section. If you have question, you can send in your questions in the comment section. So we really delve deep around stable coins and how they help to hedge volatility within the market. So one question for Osaro. So Osaro, in terms of a real product market fit in Africa, so let's assume, so we've normally seen a situation where a vendor or a product subsidize their product, and that's when they get customers. So it's more like, is every time they want to give free money or discount, that's when people come to buy. So it's more like their growth is like vanity.
Inorganic. Yeah.
Yes. Yes. So how do you identify real product market fit when user growth is high but the unit economics are negative?
Oh, thanks, Pascal. That's a good question. Um, so you want to look at other indicators, right? Beyond unit economics, which I mean, if you see this, I mean, if you see these indicators, then you probably have a good market fit. You only now need to work on your unit economics in terms of how do you then move into profitability. But then one of the first things is this. I mean, like you said, first and foremost is you want to see if your growth is organic or inorganic. And what is organic growth? This is a growth that comes in without me doing so much marketing. It's like these people are coming to the platform, they're using the service without us having to spend so much. My cost of acquisition is lower compared to people that are coming in, right? It shows a need for the product. That's why people are coming in by themselves. People are referring other people. So you want to look through your customer acquisition costs. The people that are coming in, do I need to pay for every one of them? If the answer is no, that I don't need to pay, then you probably have a good market fit. What I then need to work on is maybe I need to look through my production value chain. What are those elements that are still expensive that I can make, that I can reduce the cost there so that I can then increase my margin in that sense? Number two, you want to look at your retention rates. Am I having repeated customers? So these people come, are they retained? Do they buy again? Do they use service again? Or do they churn? So you look through your life cycle value chain. Everybody who has come in over the last 3 months, how many of them are still using? I mean, let's use a shorter time period. Everybody who has come over the last 3 weeks, how many of them are still using the product or are paying again for the product? If, for example, the product is a product that is needed maybe weekly, you pay for weekly, or something needed daily. How many of them are staying? How many of them are resubscribing again? How many of them are paying it? How many of them are using that service again? Now, if you are having those repeat customers stay there and your retention rate is super healthy, then you probably have a good product market fit. You only need to figure out how to make that unit economics work, right? You want to also check your net promoter score. So what do I mean by that? How many people are referring your service to other people, right? How do you may quickly just run a survey among your users to find out how they knew about your business. You find out that maybe quite a large percentage of your users in a particular time are saying they were referred. That shows a quite healthy net promoter score. So it means there's something there. And for people to keep coming and keep paying for it, it means there's a need for that product, there's a need for that service. You only need to figure out how to get that unit economics to work. And we can talk about that in another discussion. The frequency of use, your daily active users, your monthly active users. So you got to be able to look into your data and look at it very objectively and see what's happening. Look at the user behaviors, looking at your data. Look at them. What's my churn rates? What's my retention rates? What's my acquisition costs? Is my acquisition cost reducing as more users are coming in over time? Then you know that you probably have a good product market fit. If these metrics look very healthy, the next thing to then do is to say, okay, come, why are we not getting this? Why are we not breaking even? So you want to then go back. Can we look through my production chain, that value chain itself? What element here can I augment? What element can I improve on? Is it on maybe the server solution we are using is quite expensive? Is there a cheaper server solution I can go to which will bring down my cost of production, right? Or am I supposed? I mean, this business right now, can this business move to a cheaper location? Can you operate from a cheaper location while servicing this place so that I can bring down my cost of rent, right? Do I need 10 staff at this point in time while I'm paying 10 people salary? Can I reduce the start this salary? I mean, the people I mean, do I need these 10 staff for a start? Can 8 people, can 7 people do this job better and still be effective so that we can cut down on those recurring operational costs? To the end that we did our operational costs and they were able to have our margin, our profit increase over time. So you want to look at those metrics again, like I said again, look at those metrics, look at the data, look at those metrics again. If those metrics look healthy, then you want to go and look into your production line itself. What element of cost can you affect that will bring down your cost? So Brady, if retention is low, right, and you must pay to acquire every user that who never returns, then you don't have the product market fit yet, right? Regardless of how fast you are growing, because you just may be growing because you are providing discounts and subsidies. Those are not really good. This growth that are driven only by discounts and subsidies, they are not really good, because as soon as you take away those subsidies many times and those discounts, the users are gone. And they're pretty much gone. We saw that in Web3. Was it 2023, where we had some airdrops. Cathy, I mean, basically you may know them, Cathy, Amstar, all of the exchanges, because they were doing quite a lot of promotions around it. All of the exchanges were bubbling, metrics went up. But as soon as that campaign ended, all the numbers went down, because it's not. I mean, that's an extreme example. But it just shows how you can't use if discount and promotion is what is driving your growth, they probably don't have a product market fit yet. Yeah.
Okay, thank you very much, Osaro. So that's like a very, very deep insight on real product market fit. So in summary, for you to be able to ascertain whether you've reached a real product market fit, your growth has to be organic.
Yeah, kind of, right. There's the organic side. I mean, you incur some costs on acquisition, but the point is that your CAC should ideally, you should be reducing as your users are coming in. That's what shows
As
that
you are growing, yeah.
as you are growing, your CAC should be reducing to a large extent. We should be seeing some marginal decline in our CAC, which is showing that not everybody coming in is person I'm paying for to come in. It's not. Do you get the point? It's like my people that have come in already, users are coming already. They are selling for me too. They are referring me, which is very. So you see how your net promoter score ties into your low cost acquisition, ties into retention rate, and ties into user frequency also. So they just that interwovenness that they have, right?
Yeah.
You bear some cost, but it should be reducing, at a reducing rates in that sense, over a period of time. Yeah.
Okay. Thank you very much, really, Osaru. So over to you, Messi. Do you have any additions to what he has said?
Yeah, like Osara said, structural loss is dangerous when CAC rises with scale, when fraud and chargebacks rise with scale, when operation cost grows linearly with volume, when every transaction loses money after the real costs have been taken out, right? Then you should be worried. You should be very, very worried. And so PMF is not just when users show up. PMF is when they stay, they pay, and they pull others in without you begging them to. And that's when you know that you are doing something right, right? And so, I mean, sometimes you have to take some temporary losses. That's okay. It's okay when it is onboarding cost, when it is early stage inefficiency, or you are doing some promotions for a while. It's okay to have that, but you have to critique the growth, because growth can be borrowed, right? Growth can be borrowed, but PMF must be earned, and so you have to diagnose your growth. Is my growth promotional? This users come because of incentives? Is this arbitrage based? For example, if an FX product, are they here because my rate is low for now, or something is going on? There's an FX gap, or is it habit based, which is what we're trying to get to? Habit based is when users come because the product has become essential. to them, right? And so you identify real PMF when you check retention after the exciting thing has ended, when there's repeat usage with rising trust, like you say, your NPS score and all the others tying into each other. We are seeing that go. Users are keeping more balances. Customers are increasing transaction size gradually. Customers are referring others without rewards. They are using more than one feature of your product. Then you know that, yeah, we're there.
Yeah. So thank you very much, Mercy. So, founders, if you have any questions, you can drop in your questions in the comment section. So we'll come back to your questions once we go through this last question. Okay, so this question is for you, Mercy first. So, what do you think is the biggest mistake founders make when scaling across Africa?
The one that I've seen people make over and over is assuming that Africa is one market. Is assuming that because you won in Nigeria, you can win in the rest of Africa. True in some areas, right? Because Nigeria is a hard market. However, scaling across Africa is not just expansion. It is replication plus relocalization. Every new country requires a new compliance reality, a new banking reality, a new trust building motion, sometimes a new pricing model, right? And so you have to treat every market like a seed stage again. You have to think small pilots, local partners, localized messaging, local support. You have to think about that, because if you do not, if you assume that because you have done this in Nigeria or in Ghana, it automatically will be a plug and play in South Africa or in Botswana, I have an airport to sell you, uh, because it's not going to work. It is not going to work. You are going to waste your time, your team's time, and everybody's time. You have to not think about Africa as one market. It is not. It has its nuances. You have to look at what is the compliance reality in this market. We sometimes move with, I mean, innovation moves faster than compliance and regulation. We know that. We know that innovation moves faster than regulation. But you have to think, even if your product is that you're bringing to this new market is brand new and there is no regulation for it, you have to think like the regulator. You have to think about, what if there's going to be regulation for this? What compliance reality would that look like? What do I have to start doing today to start planning for that future, right? If you go into a new market, you don't see any regulation, there will be regulation soon. And you have to start thinking about that and planning for it and start building your product in that base. Do your KYC right, do your KYB right, keep the right documentation that you need to keep, and plan for what compliance can look like if there isn't there. If there is compliance in that place, check it out, find out what the regulation is. How do I adapt to that compliance reality, even if I have not gotten my license or I haven't yet? I'm trying to test out the product to see if it's going to work before I go into pursuing a license or pursuing the regulator and stuff like that. Even as you are doing that building, think around what is the reality of this market and what are the regulators saying around this product I am doing? What is the banking reality of this market? What is the trust factor in this market, right? How do I how do I solve for that last mile trust in this new market? How do I make sure that my users' lived experiences and the promise I am bringing, there's an alignment there. There's a way I can make them feel better. I can work with the trust. I need to think about building customer support as a growth function, right? Put that in there. Add visibility, proof points, your licenses, your partners. Put some transparency in there. Use community trust hubs. Build communities in that market to understand the market a bit more, to act as ambassadors for you, speakers for you, get local partners, design for trust, design around reversals, dispute resolution, clarity. Let people be able to trust you from the get-go when you are entering into a new market. Build that into your plan. Do not go into that market thinking, oh, it worked in Nigeria in this form, it will work here. Because, like you said, even in Nigeria today, there are some brands that are very successful in one region of the
Yeah.
country and are not successful in another region of the country. And that is within one country. So imagine the rest of Africa, assuming that the rest of Africa is a monolith, you will fail. There's no other way to say it. You have to look at them dynamically. You have to look at it as a living, breathing market. And you have to understand those markets, engage with the markets the way that they are, and then you'll be able to, scale into those markets successfully.
Okay, thank you very much, Mercy. So we really delved deep into this topic. So we have a question from a founder from the AVS community. So number one question is, what's the most challenging part of building a PMF? Osaru, can you take that? What's the most
What's the most
challenging part of building product market fit?
I mean, I think it's first is that job of understanding what is needed. Not and this is not at surface level. It's that it's that place of finding out exactly because I think that's where success or failures lies, right? To the end that you may think it's a need, but for them, for the people you have who you seem to want to build for, it's not a need for them. They can do without it and they will be fine, right? I'm thinking of an example. Nothing comes to mind right now. I mean, sometimes sometimes we are in our own world because of our own context. We think certain things are a need, but for some other people, they're like, no, it's not a need for me. It's not. I can do without this. So it's that job of going down through that whole mass of data that exists to understand the people's need that they are willing to pay for, and how you go about that will require it takes quite a lot. You're looking at competitors. You want to look through all the data you can find from competitors. You want to speak to that customer segment. You want to speak to a sample size of that customer segment. You want to sometimes sit down with them and immerse yourself into their. Sometimes you don't even want to see. Sometimes you want to sit down and listen. Some other time you want to observe, so that you can pick up qualitative data, so that you are seeing their non-verbal cues, the things they cannot even say that they are not saying. You are picking them up. That takes a lot of work and a bit of time to do. I mean, for example, you want to build sometimes you might have to travel and stay in a location for 6 weeks just to gather data about the people you want to build for. Because, for example, I can't imagine you want to build something for Kenyans and you're in Nigeria and you're in one place in Jos, sitting down there and feeling cool. Bro, you're going to get, I cannot tell you for free. Read everything you want to read up online. Until you get on ground, you don't see the actual reality of what's happening in Nairobi. And that takes a bit of work. It takes some work, right? It takes some work for that to happen. Or you want to get people from that place. You want to speak to them. You want to hear from them. My point is, if you fail at that side, even if you seem to have capital, you will burn your capital because you'll be building wrongly. You'll be building something wrong for a market. You'll be building a product that the market doesn't need. So my thoughts would be, that place of research is what we're not patient to do. Sadly, because there are not so much tangible proofs to show at that stage. Right? Sometimes it doesn't look like you are working, but you're actually working because that data gathering side is a lot of work that will inform your success and ensure that you don't blow up the small capital that you have to build. Having done that, then the capital development becomes the next thing. How do I get capital? That becomes another kettle of fish entirely. But that's research part. I think that's where the work is. Yeah.
Okay, thank you very much, Osaru. Messi, I don't know whether you have any addition to this. The most challenging part of building product market fit.
The most challenging part of building mobile market fit, Osara has covered a lot of that. I think I'm just going to talk about trust. Whilst your products might be right for the market, might be the right price, the right time, the right thing, do they trust you? Does the market trust you? Does the market trust your product? And the market say, if you do not build, one thing people forget is they think about support sometimes as an afterthought. And you have if the customers don't trust you, no matter how great and useful and relevant and priced right your product is, they might not use it. If they have felt scammed before by you, or something is wrong with the product that makes it feel a little iffy. You have to build that in, and that is something that that takes a lot of intentionality, and that intentionality sometimes is hard to build, to get to put into your product, but you have to do that, because if you do not do that, even if your product ticks all the boxes, you might not still make, still be a fit for that market, because the market doesn't trust you. For example, a product like PiggyVest has built trust over the years, and they built that trust largely from social media, from applying to their customer support. They largely, I think, my own theory is the customer support of PiggyVest kind of built that product to what it is, built the trust of that product, because you are sure that at any point in time I reach out to you at any platform, Instagram, Facebook, LinkedIn, what do you call it,
Twitter.
Twitter, would get support. Somebody is going to respond to me. The person responds to me timely. The person will make sure I get my resolution is resolved, and my issue is resolved. I have a good experience while doing that, and so that built the trust of it. Are there other savings products? Yes, there are other savings products that exist, but are they doing the exact same thing that PiggyVest is doing? Yes, they are. But are customers pivoting to that? No, they are not. But that's how you know. Well, I'm sure some people are, but not a lot of them, because we are seeing them grow year after year, right? And that's how you know they have hit PMF. Because even though their features have been replicated by others, they're not losing their customers to those people.
Yeah.
They, even though the pricing is similar, the experience is similar, they are not losing their customers to them. And that's how you know they have hit that spot. They've hit that PMF. And that's what you need to do to hit that PMF. You need to make sure that trust is in there. Your customers will still stay with you, through, even when you're having a downtime. Let's say something is going wrong, because you have put in trust, you have built that into the DNA of the product, you have emphasized that, you have shown it, you have shown up for your customers, you have made sure that your customers can say, don't worry, nothing do am, if they come, I've transferred to you via OP, you will get it. They have built trust in their speed. You are sure that if now OP I send them, you go get them. That kind of P, right? And that's how you need
Yeah.
to think about it. You have to build that into that product. Else, yeah.
Thank you very much, Mercy. And the final question. So, any other question, please, founders, you can ask in the AVS community. We'll just pick this one last question. Any other question can be on the group, or you can feel free to reach out to Mercy and Osaro on social media, LinkedIn, if you want to connect with them. So, the final question is: should PMF be expensive? Mercy, can you take that? Should PMF be expensive?
That's a relative question. That is relative. Should PMF be expensive? What is expensive? What do you what do you consider expensive? What are you selling? What is expensive to you? So that's largely a relative question, right? But it could take some time to build PMF. It could take some cost. It could take a lot from you to build that, right? Because you sometimes you might have to iterate your product multiple times to get to PMF, and that could be costly. Sometimes you might have to break some ideas down, or remove some features that you have spent some money building, and focus on the actual features that people want to use, and that might be costly. And sometimes the building the trust, depending on what you are selling and what you're doing, can be costly in itself. So you might want to have to hire some monikers, some trust people to come in front of you, some influencers and all of that, and that might be costly. Does it have to be? Might not necessarily have to be costly, right? But there will be some cost to it, because again, there is no way to tell the market about something without telling the market about something. And the way to tell market about something, you're gonna put some money into that, into doing telling the market about your product, about how the product solves their problems, and how they can come and test it out and try it out and all of that. And so, yes, there is some cost to PMF. If the cost to your PMF is never ending and you are never seeing any results, then maybe it's not a cost thing. Maybe it's a product thing. Maybe you need to stop. You're never seeing any results and you're spending all that money on your product. Maybe you need to stop and look at the product and say, hey, does this market really want this product? Do I when you're road to PMF, right? You really need to stop and be asking yourself hard questions. You need
Yeah.
to always stop. It's not just I'm going to PMF. Oh yeah, put the money, put the people, push it until customers retain. You need to stop in different points to ask yourself, what traction have I gained? From point zero to point one, what traction have I gained? Is there traction at all? If there is no traction at all, okay, why is there no traction at all? What is failing? How do I fix that? Or do I just abandon mission and go to another mission entirely and do that? Or, do I have to change geos? Is it a geo thing? Is it a feature thing? A feature thing? Do I have to feature pivot or geo pivot? You have to stop at different points to ask yourself hard hitting questions and not just persevere up until you get to PMF because that is the road you are going to. It has to be different. And those stopping and thinking could be expensive, you know. So yeah, it's relative in terms of is it expensive or not, it's relative. And sometimes you might lock out. You might be selling cold iced water in the desert. You don't that in that case, your PMF will most likely the cost for that will most likely be next to none. Because the first person that buys the cold ice water from you in the desert will most likely tell the others, say, hey, that guy is selling cold ice water in the desert. And in that scenario, there's no cost to that PMF because right there in the market, right? So it's largely relative what you're doing, how you're doing it, and what you're trying to achieve. And but either way, even if you are selling cold water in the desert, you will still need to buy a stand to keep your water. You will still need to have a cooler to keep that water. So there is cost to these things at the end of the day, right? So it's kind of relative.
Okay, so Osaro, any addition to this?
I think she covered it very well. What I will have what I will have to use is this: money will not solve all your problems in that sense, right? Respond quickly to, ensure that you are picking up lessons as you move, so that you don't fall into the trap of thinking maybe if we invest more, invest little, see, look at your data, look at it, and all of that. Don't think more money would solve your PMF problem. Let the market speak. What they say, take it, and you can't force the market at that level, right? You can't force the market. You can't, because you don't even have that. Except you have that much capital. But why force the market at that stage? My point is this: like you said, it's relative, depending on what your capital case is looking like. But then don't force the market. Spend little, listen to the market, look at the numbers, reiterate, pivot, and then go again. And if it's not working, tell yourself, hey, guy, this is not working. Let's go do something else, and all of that. I know we're used to saying persevere. Sometimes wisdom is actually just stopping. I know we have that mantra of keep pushing. Sometimes stopping is the wise thing to do, right? And rather than beating a dead horse, all right?
Yeah. Yeah. I cannot say that any more differently. Like sometimes you just need to let it go and try something else, or let it go, drop it, dismantle it, see where did I go wrong, or what can I do better, or what actually worked here. And sometimes, like you said, you have to listen to the market. Sometimes what you think should work is not working, and that's what you are pushing for PMF. But there's something in the background that is working that customers keep coming back for, which is not the flagship feature, is not the reason why you built the product. It might not even be what you sold to the investors that made them give you money in the first instance. But there is something that the customers are coming for. Stop. Listen to those customers. If this is what they want, give them that. Yeah.
Yeah. So thank you very much, Messi. Thank you, Jack Osaro. So just final thoughts. Do you have any advice for founders here? What are your final thoughts for founders here? So Osaro.
I would say this: keep pushing, but learn when to stop. Right? Um, don't. There is persevering, and there is overextending yourself. Understand that you are building for people, not you. You're not building for yourself. No matter your conviction, your personal convictions in the face of data, drop your conviction. If data goes against your personal conviction, please respect the data, because you are building for the market and not building for yourself. For example, If the people, for example, I mean, Nairobi is relatively cold. I mean, for argument's sake, this is just hypothetical. If they are able to walk in the cold without cardigan, because they've been used to the cold over the years, and you're a Nigerian living in Lagos and it's hot, small cold, you're very warm cardigan. You now think cardigan business is the end thing, and you want to go and sell in Nairobi, right? Those guys, though it's cold, their body is used to it, so they don't see your products. Why you feel convinced, no matter how convinced that cardigans are good for cold, the Nairobi guys won't think so because it's not what they need at that point. And my point is this: for founders, look into your data very well. Don't leave it to the data team. As the founder itself, you must learn to sit down with the numbers, right? That's why I advise people. I mean, I advise learn a bit of how to look at numbers. The devil, the angel, lies within those numbers that you are not looking at. Like Messi said, sometimes you are looking at this, but the number is telling you to move to this area. Follow the numbers. I know your gut feeling and all of that. They have their place in this. They have their place, but stay with the numbers. Your gut feeling will follow at a certain point. Now there are times where it looks like, hey, I followed my gut feeling. Those are exceptions to the rule. You can't make them the rule. Don't let's not go to the point where we say, I mean, you work with people's exceptions. What are exceptions? The data speaks. Follow that data. Learn how to interpret data, and let numbers guide your decisions, and not just your feeling. Thank you.
Thank you very much, Osaru. Over to you, Messi. Final thoughts for founders here.
Yeah, final thoughts. I just want to pick back a couple of things that Sarah said. Your intuition is great. It got you this far. And nobody's taking that from you. Hold on to your intuition. It makes sense. It has a place in here. But your data is your Bible. Love it, accept it, do with it as it tells you to do, right? Believe in it. Make sure that as you are building, you are humble enough, honest enough, tell yourself the truth of what the market is. Oh, this is not working in this market, or this pricing is too high, or this is not what the customers need, or this is whatever it is that your data is telling you. Take it, accept it, don't fight it, and pivot. It's not a bad thing. It's not. It doesn't negate your thinking or your genius as a founder. It doesn't do that. In fact, helps prop up that your genius. It makes your genius better. It makes you smarter because you are coming from a place of knowledge of I know that this is how my product works. I know what customers want from my product, and that is something I really want to tell founders. Another thing I would love to tell you is keep building. You're doing well. You're doing well. You're doing the right things. As long as there's conviction, there's a market for it. Keep building, and force be with you. Thank you.
Amen. Thank you very much, Mercy. Thank you, Osaru. It's been a very interesting session. I'm sure founders here learned a lot. A couple of people are dropping questions. So you guys, you have access to the community, the WhatsApp community group. You can drop your questions there. If you need to reach out to Osaru or Mercy, you can reach out to them. And looking forward to seeing everyone at the next conversation. So once again, thank you everyone for joining this session. The founders that joined in, thank you very much, Osaru, for creating our time out of a busy schedule to join this session. Thank you very much, Messi. I know you've been very, very busy too. In fact, you mentioned before you joined in, you needed to finish up some work to be able to join in. So thank you very much for creating our time to share your insights, your knowledge and experiences with founders who are building the future of Africa. We look forward to engaging more and seeing how we can support more founders to build better products for the country and for the continent. Thank you, everyone, and do enjoy the rest of the day and the week. Thank you. Bye.